It's a real privilege to have with us today Asif Suria, founder and CEO of Inside Arbitrage. Asif brings a unique blend of deep technical expertise and market experience, having started his career in technology during the early days of the internet and later transitioning into investing.
But I'd also noticed that sometimes you participate before the last spinoff happened and you pick up the spinoff at a very low price. I just got lucky on Vernova doing as well as it did. The same thing with Western Digital and SanDisk, right? SanDisk was a cyclical memory division that Western Digital wanted to get rid of in some sense.
This podcast is sponsored by the Capital Alliance Mastermind, a private community where fund managers share deal flow, build relationships, and grow together. Join the waitlist in the first link below.
So, hey everyone, Ken here again with volatile, and we have a great guest today. Someone who I've really gotten to know over the last year or so, who I really didn't know at all. So, Asif Suria is based in the Bay Area and has an incredible research service that he's started with a very unique background. So, I'm excited to have Asif on our Capital Alliance podcast today.
Thanks for having me on, Ken. Thanks, Vatsal. It's a pleasure to hang out and talk to you guys for this podcast.
Yeah, awesome. So Asif, why don't you tell our listeners or viewers, I guess the video podcast, a little bit about your backstory, your where you started, where you're from, and then how that brought you to where you are today.
Sure. So growing up, I was in India, the southern part of India. And I was at a state or in a state that it had three kinds of weather. You had hot, hotter, and hottest weather. And so after that, when I moved to Oregon, it felt like I was in heaven. You wouldn't see the sun for 9 months in a year. It would rain all the time, and it was completely green. So really like my time in Oregon. Got started in technology and investing around the time the dot-com bubble was bursting. So I was fixing the Y2K bug for a university system, an enterprise level university system. I would fix parts of the system each night and they would get to use it the following morning. I also got started in investing during the dot-com bear market, which was very deep if you were invested in tech stocks. So, got started with scars first instead of enjoying the upside, if you will. And that is a great way to get started with investing. You start to learn about risk management. You start to learn about the downside of things, which is a double-edged sword. On the one hand, you do realize that you don't want to be leveraged. You don't want to go out too far into the risk profile. But on the other hand, it can also limit opportunities because then you know that you've gone through multiple bear markets and you want to be a little bit more conservative. And that creates opportunity cost. So I started investing during the dot-com bear market and then continued on through the great financial crisis, 2007, 8, 9. I had a long short portfolio then. I was short, for example, a mortgage lender. I was short an RV manufacturer and things like that. But that still didn't help a whole lot, depending on where you were invested. That was a very significant impact on the portfolio on the downside. So that is where I started thinking about event-driven strategies. I had read Greenblatt's book, You Can Be a Stock Market Genius, and that really appealed to me, that you could focus on specific corporate events and that you might end up with uncorrelated returns that weren't driven necessarily just by broader market conditions. And given my technology background, I ended up building a set of tools. So one of the strategies I was interested in is called merger arbitrage. And I wanted to be able to track every active deal in the US and figure out what the spreads on the deals were. A spread on a merger arbitrage situation is the difference in the price between what an acquirer, say, for example, Microsoft, is paying for a company, for example, Activision Blizzard, and where the company is trading at currently. So you have the opportunity to pick up the difference between the current price and the acquisition price. And so I ended up building tools and technologies around these investing strategies. And that's what created Inside Arbitrage after a few years.
Awesome. And just to go back to it really quick, because I was curious about it. So which part of India are you from?
So I'm actually from the state of Gujarat. That's where my parents are from. But I grew up in the south.
Oh, so
yeah, so it was mostly
I'm
Kerala.
Gujarati too. Oh, so Kerala. Okay, so you're Gujarati, but you grew up in the south.
Exactly. I grew up in the south.
So do you feel culturally more Gujarati or more like from the south area?
So for any of your audience that's listening that is from India, I am Khaman Dokla by origin, but I'm more Idli Dosa by,
Okay, I think you
growing
just
up in
answered.
the south.
I.e., you're more like culturally Southern Indian.
That's right. Yep.
Yeah, interesting. That's really interesting because I'm Gujarati, so
Yep.
um, yeah, it's very very interesting. And what brought you to Oregon?
So I came to Oregon for a master's in computer science. So I wanted to study and ended up there. This was during the dot-com bubble, 1998, 1999. Exciting time. My first course in grad school was actually artificial intelligence. And AI and machine learning back then was completely different from what it is right now.
Totally different.
Yeah.
Yeah, I was a computer science graduate of Columbia University, but 1991.
Oh, got
So
it. Yeah.
I used to like be very fascinated by AI in the 80s
Yep.
and the 90s even to an extent. But at that point, I had moved on to like law school and then working as an investment banker. But yeah, it was expert systems and Lisp and things like that. But actually, I had a very successful friend who was at MIT when I was at Harvard Law School, and he was used to work in Patty May's lab, and it was about genetic algorithms. And some of that work, I think, has turned into some of the stuff. And neural networks also were a topic of conversation as well. So just sort of, I'm actually very happy to be alive at a time when all of that has suddenly started working, and now we have actual what I dreamed of is real and accelerating. It's really pretty cool.
Yeah, in many ways, I was involved with a machine learning project in the 2010s, and we were using algorithms that had been written decades before that. And the difference, I think, over the last decade or two has been about access to computational power and access to large amounts of data. That didn't exist back then when we were learning about machine learning or using AI. And that's
Hmm.
been a huge transformation. So the algorithms on the frontier models are getting better, but it was the data and
Hmm.
the computation power that made a big difference to the field.
Yeah, I want to come back to this topic because I think there's a lot here that isn't really been talked about too much publicly, and probably hasn't been really thought through either. But I think we could have a nice conversation around that. So, and then at that time, like, what interested you in computers or IT or whatever?
One of the things I enjoyed was building enterprise systems like SaaS kind of systems using web-based technology. So you had this a period of time. It was a period of transition. People were transitioning from client-server technology to essentially the web and SaaS. And that part was very exciting to me because you could build tools, you could build things, and you could see people using it the next day. And that was exciting to build systems at scale. I also implemented a large number of enterprise systems, Epicor for a retail company, NetSuite for another organization. And so being able to see how each of these SaaS companies were being used, although Epicor wasn't SaaS, it was old client server architecture, but NetSuite was SaaS. So watching that get rolled out across industries was tremendously exciting and gives me some perspective on what's happening with the software failure, if you will, or perception of failure at this point in time.
The SaaS apocalypse. We're going to talk
Exactly.
about that too.
I have a hard time
So
saying that word, but yes.
yeah, okay, I'll say it for you. How did you go from that to investing and being passionate about investing? Is it simply as much as like running into Joel Greenblatt's book, or was there some more of an arc to it?
So I got started like most people as a traditional value investor. I read Ben Graham and Phil Fisher, so on and so forth. And then Greenblatt's book really appealed to me. So I read a bunch of books by that point. I'd been investing for nearly a decade at that point in time, but it was more from the old school value approach, right? You're looking at things that were trading at cheap multiples based on either you running a DCF model or looking at comparative valuation metrics or trying to project the future. Greenblatt's approach was different. It's specific events. It's a spin-off that would unlock value, for example, or a merger situation that helps you do better than, let's say, fixed income investing. So, for example, I normally did not focus on fixed income investing because interest rates were low in the US for the better part of 10 years. After the great financial crisis, all the way through after COVID, until the inflation started going up in 2022, interest rates were essentially below 1%, except for a 2 or 3 year period towards the 2017 to 2019. So in that period, fixed income investing did not necessarily generate great returns unless you went out on the risk profile. And so merger arbitrage provided a very attractive opportunity to me at that point. You could get returns anywhere from let's say 6% to 15%, depending on the kind of mergers you participated in. If you went for the risky mergers, you essentially were constructing a portfolio that was like investing in junk bonds, high returns but high risk. But if you were to invest in certain other kinds of mergers, you could pick up anywhere from 6 to 8 to 10% returns that had, in some ways, a profile that was similar to fixed income, but much better outcomes. And so that's one of the pieces that attracted me a lot to another side of event-driven investing.
So you read the book, but like, how do you figure out like which mergers or what's gonna, what are the opportunities? Like, it's a lot to keep track of.
Yeah, and that's why I ended up building the technology tools around it. I was an active investor. It was my passion at that point in time, and I started writing on in public in 2006 on Seeking Alpha, and that helped create a network. People were reaching out. There were hedge fund managers that were reading what I was saying, and they started sharing some of the research around M&A with me. So that helped me get a little bit of a head start. Keeping track of anywhere from 80 to 100 deals that are active in the US is not easy. And so I ended up building tools. We started pulling data directly from the SEC because you have to track the merger from the point of announcement all the way to closing, which could include shareholder votes, it could include antitrust review, it could include financing contingencies, so on and so forth. So there were a lot of different events that you had to track along the way. Obviously, I learned by doing. So if you looked at what we were doing back in 2010 when we started, I think it was a very simple data set where we were mostly tracking the spreads. But over time, we ended up layering in some of the understanding and the complexity that comes with working with the strategy for a long period of time. And so I realized that a large number of hedge funds and other professional investors were starting to use our tools. They were free for a number of years. And then about 8 years ago, as we had grown the platform, I figured it was time to potentially make Inside Arbitrage into a real business. And that's when I switched over to essentially making it a research platform and expanding from there.
And you always did that along with your career, is that correct? Or
That's right. Until about 5 years ago, I did have a technology career, and 5 years ago, I started focusing full time on the research platform and investing.
okay, I think this is a good time to tell our folks. I'm really impressed by the platform you built. I think it's largely subscription driven, if not fully subscription driven, right at the
That's
moment.
correct. Yep.
So, but I know it's broader now than just merger arbitrage also. So talk
Yeah.
about what the platform is, who it's for, how it works, how it helps investors. I mean, make it a broad discussion about insider arbitrage.
Yeah, so we started out with two strategies. I was fascinated by what was happening with insider transactions. And these are legal insider transactions, not the one where somebody lets you know in advance about something that's going to happen. This is about company insiders. It could be a 10% owner, it could be a CEO or a CFO, or even somebody on the board of directors that is buying stock or selling stock on the open market. When they do that, they have to file a form with the SEC called the Form 4 within 2 business days of the transaction. You do see that at times they forget and they file this form quite late, but for the most part, it's supposed to be done within 2 business days. And I remember reading a quote, I think it was by Peter Lynch, that said, insiders sell for all kinds of reasons, but they buy only for one reason. They think the stock is going up. I think that quote was said at a time when the insiders were not necessarily buying to signal the market. But over time, the insiders figured out that, people like you and me might be looking at these insider transactions, and they started buying just to signal the market. So you might see a cluster purchase, you might see a CEO buy. So essentially they're letting you know, hey, we are buying, maybe you should take a look at a company. So that made the data a little bit more noisy. And so you have to kind of try to understand the motivation behind why they're buying. And Ken, something you've said before, the who rather than the what is important. And again, the same thing applies with insiders. You really want to understand who is buying and what their motivation is, and not just what they're buying. So I started out with insider transactions and merger arbitrage, mainly because again, with a technology background, I was able to process Form 4 filings we would collect it within minutes of it hitting the SEC, and we would do data analysis on the data to try to understand if there were patterns we could find, whether through machine learning or through traditional data analysis. So we started with those two pieces. And as we saw that, we ended up with a large number of subscribers who were taking a look at this data, I figured I was going to expand to other event-driven strategies. And so we included spinoffs at some point in time. So we started looking at upcoming spinoffs and completed spinoffs. Then we started looking at stock buyback announcements. SPACs became very popular at one point in time. You had a whole SPAC bubble, if you will, in 2021, 2022. We were tracking SPACs. And then most recently, we started tracking activist investors a couple of years ago. And so this grew organically because as you think about companies, you realize that there is an overlap between things. And one really good example that I usually use is a company called Biohaven. So Biohaven was a company that made migraine-related drugs, and Pfizer was interested in acquiring the company, but they were only interested in acquiring the migraines portfolio of the company and not the rest of their pipeline. So they decided to spin off the rest of the pipeline at the point the merger would close into a separate company. And just to make it difficult for all of us, they decided to call the new company Biohaven as well. So you had the old Biohaven with the migraines company products that were going to be acquired. And then you had the new Biohaven, and the whole management team of old Biohaven was going to go into new Biohaven. And Pfizer, unlike most spin-offs, where the spin-off is actually loaded with a lot of debt to leave the parent with a cleaner and stronger balance sheet, in this case, Pfizer was going to fund the company, the new spin-off, with, I think, if I remember correctly, maybe $350 million in cash. So you had the situation where you ended up with a pipeline of drugs, you had $350 million in cash, and it was a merger. So you had a merger and a spin-off happening simultaneously. The stock was trading at, I think, about $141 when I got involved. The deal price was $148.50. So I would pick up like $7 or $7.50 when the deal closed. So that was the merger arbitrage portion. And if you looked at how many shares were going to be outstanding in the spin-off after it happened, I calculated it to be about $7 per share. So I figured if nothing else, if it traded simply at the cash value, I would pick up another $7. And so I participated in that merger. And then right before the deal closed, I noticed that just a few days after all the approvals were in, an insider of the company bought stock at $148. So he was not buying it for the 50 cents merger arbitrage spread. That did not make any sense. This was a board member who had been on the board for several years. He had been an emergency room a physician or a surgeon. So he had the medical background, and he was excited about the pipeline for the new Biohaven. And that's why he was buying. He wanted to be able to pick it up in the spinoff. The spinoff happened. A company started trading a little over $7. My thesis was essentially complete at that point, so I ended up selling the stock. And then it went all the way up to $60 per share. They ended up doing a bunch of secondary offerings in which the insiders participated. So this was a situation where, three strategies we were following: a spin-off, merger arbitrage, and insiders came together. And so I realized that the power of the strategies is not just one strategy in itself. It's the overlap and the patterns that you start to observe over a period of time as you look at this data very closely every day.
Yeah, that's really fascinating. So you mentioned, was it 6 strategies?
Yes.
6. Is there any way to, I don't know if you've tracked the data or whatever, like, is there some strategies that relatively do better than others? Does it change over time, or is it like in the long run versus the short term? Let's help our audience get an intuition about
Yeah.
which of these might make more sense depending on who they are, what their time horizon is, or whatever.
Yeah, each strategy is very different. So there are 6 strategies. We added activists later on after that as a 7th one. I did end up writing a book called The Event-Driven Edge in Investing that covers the 6 strategies. And each chapter in the book has 2 case studies. One where if you use the strategy, you actually made money. And another cautionary case study that told you where things did not go right, even if you use the strategy. So you get both sides of each strategy. There are times, just like there are seasons in the year, there are times when these strategies are favorable and they work well, and there are times when they don't. So merger arbitrage during that period of low interest rates was a very good strategy for me. For well over a decade, it worked out very well. And then the regulatory environment changed when Lina Khan was the head of the FTC and Biden was in power. You had a highly restrictive regulatory environment. And this isn't essentially a political statement that I'm making here. It's just the facts on the ground. You had a difficult regulatory environment. And so mergers not only were failing more than they would. For the most part, over the last 15 years, as we've tracked data, 95% of all mergers close. But during that period, you saw that mergers were failing that shouldn't normally fail. There was no real antitrust reason for these mergers to fail, or they were taking much longer to complete. And which is very difficult because merger arb investors look at not just the returns you get on a deal, they're looking at annualized returns. So for example, last month I participated in a merger arbitrage situation where I was potentially making about 10% returns, but the 10% returns were going to happen in a period of 3 months. So in my mind, I'm thinking of it more like over 40% annualized returns, and that's attractive to me. But if that situation took 6 months to play out instead of 3 months, then it's 20% annualized returns, not taking compounding into effect, right? So the delays in mergers are a huge issue. So during a difficult regulatory environment with higher breaks as well as longer delays on the mergers completing, merger arbitrage was not necessarily working out great. With the Trump administration coming in last year, the whole script flipped and merge arbitrage was once again in favor. Similar thing was something I noticed with spinoffs. If you looked at the 2010 to 2022 spinoffs, for some reason, a lot of those were not working. But I've had some very good luck with spinoffs. I was participating in GE before the Vernova spinoff happened. I'm currently in Honeywell at this point in time before the aerospace spinoff happens. And last year, I participated in Western Digital before the SanDisk spinoff happened. And so you have to pick and choose within the strategy. And there are, for some reason, there are seasons within strategies. At the end of the day, I think it becomes an idea generation mechanism for you. Every night we look at insider transactions. Last night we looked at 31 transactions. This week we probably already looked at over 100 transactions. And so these are 100 companies I might not have looked at otherwise, and I'm paying attention to because of this. And so for me, I see these strategies as idea generation mechanisms from which I build extensive watch lists. And then the time you look for when the time is right, maybe it's a macro issue that gives you the opportunity to buy. Or maybe you see a second signal. The company where the insider was buying also announces a large buyback. And so you have a second signal saying the insiders are buying and the company is going to buy back. And maybe they have an accelerated buyback program that's going to help move the stock up. So it is about seasons within strategies. It's about overlaps within strategies. And it's about idea generation from these strategies.
Yeah, I actually was thinking that same point because what's nice about event-driven things, so like normally, like as an investment manager, you always have like a bunch of companies that you could be looking at, or whatever, but like or you could do a screen and you come up with hundreds of companies, but there isn't really any urgency or a way to say why should I look at this one instead of that one. So you just maybe go through your screen at some pace.
Yep,
But what's nice about events is that it's like actually increases the urgency to look at these ones right now, right?
absolutely.
Because the time frame to take advantage of whatever might be going on is a limited window.
That's okay.
um,
That's exactly right.
and so I like that as a way to filter through a larger number of possible things to look at the ones where the timing could be very relevant.
Yeah,
And
yeah. Go ahead, Ken.
so has your experience been that sort of everything has its season and the seasons come and go? Or are there one or two that really seem to perennially work better?
Yeah, the seasons come and go, and I'm reminded of what Jim Simmons of Renaissance Technologies was talking about. As all of you know, they run one of the most successful quant-focused funds out there, and they have a number of strategies they use, and they experience the same thing. They will see that strategies are working for a period of time, and then they go cold, and they essentially put them into inventory. They put it on the shelf, and then they realize, okay, maybe there's a different time or a different market cycle when the strategy works, and they bring it back. I've seen the same thing with event driven. On insider transactions, it's evergreen in the sense you will get a lot of ideas constantly, but there is a macro overlay that actually gets really interesting there. During COVID, 2 weeks in the second half of March, we saw for the first time in over 10 years of tracking the data that insider buying surpassed insider selling. So we had never seen that before. Usually, insiders are selling 20 to 30 times as much as they buy each week. And so we track this data each week, we compute that. And so for the first time ever in a decade, I saw insiders buying more than they were selling. So they saw the COVID disruption, and it was a very significant disruption, both in terms of human life, in terms of economic impact on various countries. But the insiders who were deeply familiar with the company felt that the selling was overdone, and the stocks were worth a lot of money. So they were buying very significantly, and they were not selling at the same time. So that was a big macro signal for us. It helped us position more bullishly after that. And obviously, the Fed stepped in and nuked that bull market, bear market, if you will. But we have also seen patterns within industries. So, for example, in May 2020, when WTI crude futures went negative because nobody wanted to take delivery of a large number of oil barrels in Cushing, Oklahoma, you had the situation where a lot of the energy stocks were down quite significantly. And then the energy insiders started to buy quite a bit of stock on the open market. So you saw cluster buying, not just within a company, but across companies in that industry. And that was an absolutely wonderful time to have exposure to energy. There was another time similar to that in early 2023 when Silicon Valley Bank, Signature Bank, and First Republic were failing. You saw regional bank insiders step in and buy hand over fist. We just couldn't keep up with the number of insiders transactions we were seeing for regional banks. And then you saw that happen with the biotech sector in late 2024, early 2025. You could see a lot of insider buying in companies that had FDA approved products that were seeing revenue grow, but the market couldn't care less about biotech companies. And so normally I don't invest in biotech companies. They are in my too hard pile. I have no scientific background to understand which drugs are going to get FDA approvals, which ones would fail. But the insiders were buying so much, I had to pay attention. I ended up buying some and it worked out great. So with insiders, the flow of ideas is constant. And then you start to see the patterns where they are concentrating heavily within a sector because that industry or sector has been hurt quite significantly above and beyond where it should be. And so that provides an interesting industry level signal for us.
How often does a strong insider purchase not end up being an indication of a great subsequent investment opportunity? Like, how often are insiders kind of wrong? Like, maybe even though they're putting their money where their mouth is.
Very often, and this is a challenge with the strategy, right? Because very often they're buying to signal the market, as I mentioned earlier. And then there are situations where we saw a $5 million purchase by the CEO of Pinterest, the social media company. And if you read the footnotes of the Form 4 filing, he mentioned that he was buying because he would get another additional 5 million from the company if he bought on the open market. That was part of his employment contract. And so when we saw the Workday's CEO, Carl Eschenbach, who no longer is with the company, also buy maybe about $2 million worth of stock on the open market, we went and looking for that footnote to see, was he going to get paid by the company? There was no footnote in the Form 4 filing, but we found the clause on I think, page 3 of his employment contract. And we realized that he was going to get paid twice as much or more if he bought $2 million worth of stock on the open market. And don't hold me to the exact numbers. It could have been 2 million, it could have been 5 million. So there is a certain level of depth you have to have with the data to understand which of these are valuable insights, which of these are things you would best ignore. And so with insiders, they get it wrong quite a bit. But what you want to do with insiders is you want to use that as a idea generation strategy for companies that might not have come across your radar otherwise. So that's how I see them. And then you start to pick up on patterns on which insiders you need to focus on. Maybe it's not the CEO purchases. Maybe it's an independent board member that has an investing background that has essentially no reason to signal to the market through their purchase that they find the company attractive. Maybe it's a board member that's been on the board for a decade and has never bought before, but is making an opportunistic purchase now, not under a 10b5 plan, which are established plans that some insiders put in place that let them buy over a period of time. So those patterns can become very important and interesting. And so that's why a lot of people look at insider buying or selling and they dismiss it because they see that the insiders are wrong quite a bit. And like value investors, insiders also tend to be early. They get excited. They say, "Oh, my stock is down so much. It's a great value, and I need to buy." But often it'll continue going down because the market, the mean reversion tends to overshoot the mean on both sides.
Yeah, that makes sense. So I'm going to ask you just out of curiosity, like maybe a tough question, but like,
Yeah.
if you could only do one for the next 10 years, which one would you want to keep? And which of the other ones would you be willing to sort of say, okay, I can't do this one for the next 10 years? If out of the 6 or 7, you say, I only get to keep one, which one would you keep?
It is a difficult question, Ken, because it removes the power of the overlap for me, right? The
Hmm.
overlaps are very important for me. I need to see like 2 or 3 things
Right.
coming together. Um,
Okay.
it also removes the seasonality. I mean, the year is less
Yeah.
fun if you only have one season during the year.
Right.
But that
Right.
said, if I'm limited and you had to make me pick, I would pick insider transactions because of just the sheer amount of idea generation I can get from it. And for some reason,
Neat.
in some
Yeah.
ways, being irrational, I like that idea. I like that strategy a lot.
If I let you keep one more, which is the next one that you say, I wanted this one as my next team member.
So at this point, merger arbitrage hasn't been quite as attractive because now with the Trump administration, spreads have narrowed quite a bit. Interest rates are still high enough. You could get some money in a CD or a bond. But I like the strategy a lot because if you were to think as a traditional money manager who does like 60% stocks, 40% bonds, or however they do the asset allocation, the merger arbitrage provides that fixed income quality, if you will, to the portfolio. So that's why I started with insider transaction and the merger insider transactions created the ideas for the equity side. Merger arbitrage created the idea for the fixed income side. And hopefully the both, unless you end up in a very deep bear market like the great financial crisis, they are hopefully a little bit uncorrelated with each other.
Got it. And just for context, what are the other five that you didn't pick in your top two?
Beyond that, I would be very interested in spin-offs. I think they really unlock value if they're done right. You have to look at them and understand, do you want to be involved with the parent or the spin-off? And so you need to pick and choose. It's not always about participating in the spin-off. It could also be that the spin-off is leaving the parent in a much better shape and you want to be in the parent. That was my logic with GE and GE Vernova. In fact, Vernova was an underperforming division that GE wanted to get rid of. And that was my analysis as well when I participated. But I'd also noticed that sometimes you participate before the last spin-off happens and you pick up the spin-off at a very low price. I just got lucky on Vernova doing as well as it did. The same thing with Western Digital and SanDisk, right? SanDisk was a cyclical memory division that Western Digital wanted to get rid of in some sense. And they had probably made a mistake by acquiring SanDisk, and Seagate did not do that. So you had a huge difference in valuation between Western Digital and Seagate. And so once again, there I wasn't buying it for SanDisk. I got lucky with SanDisk. So sometimes, you just increase the surface area of your luck by looking at some of these situations. So I would say spin-offs would be the third one that I would be interested in. Activists, if you follow the right ones, like Elliott Management has done very well in several situations I've been involved with, I think is very helpful as well. Western Digital had Elliott involved. Honeywell, that I'm currently participating, has Elliott involved. So you have somebody with deep experience that is agitating for change at the company. So that would be another area that I would be very excited by. SPACs have come back in favor now, and for people who want to have those free warrants as lottery tickets that might pay off into the future, that's attractive, but it just hasn't been an area that I'm as excited about as the rest of my the strategies that I use.
Awesome. And how much of your portfolio is in activist things or event-driven things versus just, other things?
All of it. Every single idea I participate in has some event-driven angle to it. There is one portfolio that tracks the Inside Arbitrage portfolio. So one of my personal portfolios tracks exactly what we do for Inside Arbitrage, which is event-driven strategies. Earlier this year, we did switch to using a quantitative model for our clients and for myself. For most of our clients, some chose still discretionary picking, if you will. And so those quant models do have some event-driven factors in them, but there might be some company through the model that might not necessarily have any event-driven exposure to them.
Mhm. What was the logic between switching to a more quantitative approach?
Yeah, so we ended up building the quant model for our ideas that we were looking at in Inside Arbitrage. As I mentioned, this week we probably looked at over 100 insider transactions. So every night we look at insider transactions, we look at buyback announcements, we look at spin-off announcements, new mergers. And so in a given week, we were running across dozens, if not sometimes hundreds of companies. And the human mind just can't process that much information or retain it. Processing it is one thing, retaining it in memory is a different thing. And in many ways, when you think about machine learning or AI, it is about pattern matching, which is what we as humans also do. We use our prior experience and knowledge, and hopefully wisdom. Knowledge doesn't equal wisdom in all cases, to pattern match against a set of new ideas. And what I realized was there was no way to do in-depth work on this volume of companies. And so we ended up building a quantitative model as our first filter. So think of it as a screen, a favorite screen that people use. And this quant model became a screen. So if a company scored, let's say, over 70 on our quant model, then we will take a deeper look. That was the idea behind it. So that's why we first built the quant model, and we used it for a period of 14 months. And as we kept using it, it built a confidence in the model, and we realized this is actually quite useful as a tool for us to invest, as a tool for us to whittle down and figure out companies we should focus on. So once we did that, we actually did the back testing. So we didn't do the back testing to pick the factors. I've done enough machine learning and things to know that you could torture the data to make it confess, and essentially you could overfit the data, if you will. So we didn't use machine learning to build the model, but we did go and backtest after we'd been using the model for 14 months. And the results we saw from that were exciting enough. We figured that it made sense to switch to a quantitative approach.
This podcast is sponsored by the Capital Alliance Mastermind, a private community of asset managers and investors building something real together. Members gather in person a few times a year to tackle the hardest problems in investment management, raising capital, scaling operations, and building relationships that move the needle. What makes it different is the room itself. These are people who share deal flow, make introductions, and hold each other accountable, because everyone is committed to giving, not just taking. We're currently building our next cohort. If you manage a fund, join the waitlist in the first link in description.
Mhm. And can you talk about like who subscribes to your service? And is it sort of like different things for different, like say if somebody, I would assume some of them are just individual investors like you started with who are interested in event-driven things. But there must be also institutional. Is it so? And if I'm interested in subscribing, like what are my options? What's the cost? What do I get? Talk about that.
So we started out focusing on event-driven investors who are often professional and institutional investors. They were hedge fund managers because there aren't that many retail people seeking out merger arbitrage as a strategy, if you will. Insider transactions are more accessible in some sense. It makes more sense. Merger arb is a little bit harder to get your head around. So we started out on that front, but we had a whole spectrum of retail investors to institutional investors. And more recently, some of the largest ones. So, for example, some of the largest merger arbitrage funds use our data. They're paying customers. Probably one of the top 5 largest quantitative firms in the country or the world uses our data as well. So as we built it out, we realized that we had ended up building tools and a long history of quality data that it started attracting that level of institutional clients to sign up. And in terms of what we offer, we had a premium plan that included a combination of tools as well as content. So we do the analysis as well. So for example, this week we wrote about a company that was seeing both insider transactions as well as a large buyback announcement that was nearly 17 or 18% of the company's market cap, and it included an accelerated buyback. So we did an in-depth article about the company, comparing it to competitors, looking at how the Sasopolis, Polis, or Sasacopolis, what we call that, was impacting this company.
SaaS apocalypse.
Ken, I'll just ask you to say that. So that's impacting the company, and you could see that because the stock is down so much, the insiders and the company is buying back stock. So we do the analysis as well. And then at some point, we realized there were a group of retail investors that didn't care as much about the tools. They just wanted the analysis and the ideas. And so we created a lower tier called IA Plus that is mostly just the content and the ideas that we write about. And so retail investors gravitate towards that. Professional investors who like having access to the data use IA Premium. And then we created a higher tier called IA Professional that introduced for example, a CVR database, contingent value right database that we had built over 15 years. The activist part of it, that was a 7th strategy, if you will. So certain additional tools that might appeal more to the largest institutions, we ended up creating a tier for that as well.
hmm And we can put this stuff in the show notes, but how does somebody subscribe? What's the cost for the entry, the beginning tier that you can get some ideas in a newsletter
Yeah.
format, I suppose?
So IA Plus is about $480 a year. I think on a monthly basis, it's $50 a month. IA Premium is $1,200 a year, and IA Professional is $4,500 a year, but includes 4 seats. So different people within the organization can maintain their own portfolios, watch lists, mergers they're interested in, so on and so forth.
That's great. That's a good value.
Hopefully, yes. And a large enough portfolio, I can see it adding value.
Yeah, I mean, if you think about it, like just one idea could more than pay for, even if you were a professional subscriber, working with just not huge amounts of capital. So
Absolutely.
I think that to me, that sounds like great value. I mean, a lot of when I had written research at one point with a partner, actually a really well-known guy named Murray Stahl.
Oh,
And
yes.
there's a whole business of people that they sell, research to hedge funds and things like that. And many of those funds, I don't know if it's changed now because this is going back when I started Ridgewood, so we're talking 20 some years ago. But I know that many of those subscription services were like $20,000 for one series of reports. But the thing was, like, a lot of these firms, they have what's called soft dollars. So they're essentially told by their brokers, who they're trading hundreds of thousands of millions of dollars of trades, that, hey, we'll give you soft dollars so you could spend it on research, or you could spend it on Bloomberg or whatever. Airline miles or Amex points or something. Is by being a customer, you get some value back. You can spend it on whatever, in that case, research or whatever. I don't know if that system has changed, because this was even pre 2004, but certainly to me, when I hear the pricing, I think it's an amazing bargain.
Thanks again. Yeah, you're right. I think some of that has changed. The soft dollar part of it has changed. Brokerages probably aren't making as much in transaction fees as probably they're making on making loans to some of these funds. I think some of the rules around it has changed as well, but that could be a potential revenue stream for somebody who's aligned
Mhm.
with that. I'm glad you brought up Murray Stahl. I think he started out with spinoffs, the research service.
Yeah, yeah. So one of his reports was spin-off report or something like that. I forget what the exact name of it, but
Yep.
yeah,
And we used to
I
see
helped
his
him start one of his reports. I forget which one.
Interesting. And we used to see his insider purchases all the time. He buys, he's part of Horizon Kinetics. He buys TPL,
Mm-hmm.
Texas Pacific
Yeah.
land, and you can see
Yes,
him
he
buying
does.
those.
Yeah, yeah. Yeah, he's a very brilliant guy, extremely erudite, very intellectual, very independent thinking. So his research is actually super interesting to read. And I've met him a number of times. I really respect him. So, and also I should tell people who are listening that you have a great podcast as well, where you interview a lot of great people with your daughter, who I think is great as well. So tell people about that, and then I'll let Vatsal ask a couple of questions as well. I'm sure he has a bunch of things that he'd want you to talk about.
Yeah, we launched the podcast a little over a year ago in January of 2025. My daughter Tamanna has been working with me for the last 4 years. She has been looking at these insider transactions with me every night. We look at the footnotes together, so on and so forth. And I had her start to write some of the research with us. And the first few companies I gave her were all regional banks. And she was, after a few weeks, she was like, this stuff is really boring, these regional banks. I don't know why you keep making me look at these. And as you remember, this was in early 2023, and the regional bank insiders were buying quite a bit. And then the Silicon Valley failure started to happen. And by that point in time, she had started to get grasp what was happening with regional banks, how to think about these companies, that the Silicon Valley Bank whole scenario actually was something that made sense to her and was interesting. So together, after she'd been working with me for a while, she decided to go study business economics at UCLA. We decided to do a podcast together, just to, on a weekly basis, talk about the most exciting event-driven strategies or stories that came about. And we figured we'll have maybe one guest a month. And more recently, it's been a little bit more frequently on the guest side. But it's been great to tap into somebody who has been following, for example, the Paramount and Netflix war for Warner Brothers. And this is somebody who's was previously an equity research investment banker focused on TMT, and he was following the situation really close. And so it was great to get somebody like that on for an hour and just talk about what's happening with that merger situation. So we've been highly fortunate to kind of have some guests who are experts within the field and just come and talk to us about this and explore ideas. Can you introduce me to Evan Tyndall, who's part of the Capital Alliance? He was a guest on our podcast as well. And so just having the ability to have these conversations with these experts has been very enriching for both of us.
Definitely. Vatsal, do you have any things you want to talk to us about?
How do you think about different event driven opportunities like spin offs, activist involvement, and even things like SPACs? And how do you decide where to focus your attention?
That's a very interesting question. I've never had that question asked before. So let me think about that for a minute. In value investing, often we think about buying something that is at a reasonable price, maybe a good business that might have a catalyst, right? A lot of people focus on a catalyst. In event driven, you're starting from the catalyst. So the catalyst is already happening. Somebody's announced a spin off situation, somebody's announced a merger. And so, somebody who wants to succeed at event driven investing, your catalyst is already in place. Now you're essentially assigning probabilities that the deal will close, probability that the spin off is structured in such a way, hopefully not loaded with so much debt that they're not going to do well. So you start looking at the situation and you start assigning probabilities to them. So you have to be extremely detail oriented. You have to pick up on every single twist and turn of the merger situation or the spin-off. You also have to be somebody who thinks very probabilistic, which is why a lot of the merger arbitrage folks sometimes end up doing very well in other areas of investing. So if you think of John Paulson and his trades, he did extremely well. He was a merger focused investor. But it essentially ends up inculcating these habits in you where you are very detail oriented and you think probabilistically. And I think that carries through into other realms of investing if you decide to go past event driven.
Is your entire portfolio built around event-driven strategies, spin-offs, activist involvement, and what led you to introduce a much more quantitative model into your process?
Yeah, so you hit it on the head. The difference between the perception versus reality, you're trying to somehow tread water in that ocean, if you will. And you're hoping that your perception is more relevant than what the market is telling you is happening. And so with event driven, what happens is you get some external input from the insiders buying, for example. And so you'll see across the industry that a lot of insiders are buying, and that might help you with your perception of what's going on. Or you might see significant buyback announcements with accelerated buying, if you will. So you get these external inputs. So obviously you have a view of the market, you have a view of the industry, that's your perception. And then what's happening, the market is telling you something different potentially. And often these days with the markets being as efficient they are, if you go against the trend, or if you go swim against the current, you're going to drown. And so if you do choose to do that, you feel like you make the biggest money when your perception is correct and the market is wrong. The input the event-driven stuff provides, either through insider transactions or buybacks, might help you build some confidence to stay the course, right? Often as investors, if you've done the deep work yourself, you also have the conviction to stay with the idea for the long run. But if you haven't done the deep work, then you don't. In this case, the events are providing some of that input and the pattern matching to you. When an industry is in trouble, you often see that there are bankruptcies first, and then there is M&A activity, and then you start to see that these companies start to emerge out of that downturn. But before the bankruptcies and before the M&A happens, you often see the insiders because they are quite early. And so if you start seeing a significant amount of insider buying, you should realize that they're going to be early and the next few months might not be the best. But if you think longer term, that might work out well.
With so many opportunities, insider trades, mergers, buybacks, how do you actually process that volume of information? And what pushed you toward building a quantitative screening system?
And you're absolutely right. That's the reason, as I mentioned in the book, I had one case study for each chapter where something did not go right. You have to understand how and why, when things go wrong. Things can go wrong for a number of reasons. We talked about Lina Khan at the head of the FTC, and there was a merger between Tapestry and Capri. This is the company that owns Coach, that was acquiring the company that owns Michael Kors. And the CEO of Capri was buying this week, just as a heads up. It was interesting to see that. So this was a merger where there should not have been any antitrust issues under a normal antitrust environment. And so it did get blocked. And you're essentially, what you were doing is you were not just pattern matching against your previous experience with mergers and probabilistic thinking. You have to pattern match against a new environment, and you have to say, how does this change things? Even though the deal makes sense, the regulatory environment is so different that you need to readjust your probabilities based on that. So I think some of that happens. Yeah.
What separates a successful event-driven investor from a more traditional value investor, especially in terms of thinking about catalysts and probabilities?
No, it's difficult. I probably looked at well over 1,000 deals at this point in time, right? So I'm pattern matching against a larger data set, if you will, as I think about this. And each situation is unique, which is why the detail-oriented part of it is important, because you can't just say, oh, all right, I've seen this before. This spread is 3%, it's likely to close, or the spread is 12%. For example, Cintas this week acquired another uniform company, and the spread is almost 12%. And that makes sense because there are only 3 or 4 uniform companies, if you will, that provide uniforms to corporations. And when Cintas is trying to acquire one of the biggest companies in the industry, you can see that the spread is 12%. Now, at this point in time, the question becomes, what kind of probability am I going to assign to this? And what is the market telling you? And is there a mismatch there? Even before I looked at the spread, I looked at the deal and I was like, this is going to have a really hard time getting through regulatory approval, right? So that's the pattern matching part of it. You just look at it and you say, we've done work on Vestis, which was spun out of Aramark. This is another uniform company. So we'd already done the work on what's happening with professional uniform companies. And so as soon as the deal was announced, it was like, this is going to have a difficult time despite an easier regulatory environment. So your pattern matching, not just against 1,000 mergers you must have looked at, you pattern matched against the experience you had with the industry when you looked at a spin-off in the same industry. So I think of it as a mosaic, Vatsal, where you're pulling all this information together from all these strategies that we've looked at for decades, if you will. And hopefully that gives you a little bit of an edge. It doesn't always. We get it wrong. I get it wrong quite a bit. But hopefully over a long enough period of time, your outcomes are better.
I want to come back around to SaaS and AI.
Yeah.
It's both are, a lot going on there. Is there any insights that you're getting from the signals through all these different data that you're collecting that might be interesting for the people who are trying to figure out what should I make of the SaaS apocalypse? All these companies have traded down. Is it more of an opportunity, or is it more of an impairment of a moat that might be more permanent?
Yeah, Ken. So I'll break it down into two parts of this. So one is the impairment of the opportunity, if you will, or impairment of the moat, rather. Yes, there is impairment of the moat. AI is transformational. Nobody fully understands or knows how the whole thing plays out at the end of the day. But yes, it means there could be more startups that show up on the radar that have vibe coded some part of a feature, if you will. But again, if you have some background in technology, if you've written code, if you built enterprise systems, you know that it goes above and beyond just writing code. I wish it was that simple. Maybe 20 to 30% of a company that is related to technology or SaaS might be about code. You also have to find the customer market fit. You have to basically figure out how to fund the company. You have to figure out what your customer acquisition costs are, how long you're going to retain customers. There's a whole lot more to building and scaling a software business than just writing code. So I think there's a sense of people thinking established companies that have that deep expertise in the domain are going to get disrupted overnight. I don't think that's going to happen as the market is perceiving it will. And I'm saying this as somebody who's written a lot of code, who uses AI, who understands that the frontier models are very powerful. So it's not as somebody who is completely agnostic or not interested in AI. On the other hand, these companies are also not sitting on their hands watching this play out. They are starting to use AI. They're encouraging the developers to be more productive by using AI. They are buying AI companies. So Workday has acquired 4 AI companies in a row, or 5 AI companies in a row. Salesforce.com is pushing Agentforce. All their conversation is about AI and Agentforce. And at the same time, they're using this market disruption to borrow money. They just announced a large debt offering to buy back stock, and they're going to do accelerated buybacks. So I can see that these companies are not sitting there watching this play out in front of them. They are participating in it, either by using AI internally or by participating in the capital markets, either through buybacks or you see a large number of insider transactions. I've seen over 30 insider transactions in software or software adjacent companies since the start of this year, and over 60 buyback announcements at these kind of companies over the last year. So I have a rich data set that I'm exploring and writing about. I'm going to write about it this weekend, actually. So I feel like, yes, things have changed, but the market might be overdoing things as it usually does, and the pendulum has swung too far to the other side. Now, that said, to begin with, the pendulum was very much on the wrong side because these SaaS companies were being afforded valuations that didn't make any sense. Everybody was focused on adjusted this and adjusted that. Stock-based compensation was, not being looked at. So nobody was paying attention to GAAP profitability. And all of a sudden now that's come into view. So you have this, I think it's a two-step thing. Terminal values are now in question. People are looking at these extreme levels of stock-based compensation and the fact that GAAP profits don't exist. And then on the other side, AI, right? So I think some of the rationalization that has happened in valuation is simply because people are now looking at this the way they should have been looking at them all along.
That's great insight. Obviously, this is the Capital Alliance podcast. It's not limited to obviously anybody in Capital Alliance, and this is I think at least the 4th episode. So, but you're the first person on the podcast. There'll be others who isn't a member who's experienced the community. So I'd love to share obviously we're selective about it's a curated community. It's only for founders and partners of folks involved in professional investing at some level. But so share a little bit about your experience and what's been the value or why you decided to make an investment of time and money to be a member of Capital Alliance.
Yeah, so I was at a dinner last weekend, and some close friend of ours were asking us. They were asking me, "We noticed you've been traveling quite a bit. What's causing you to go to all these different places in the country all of a sudden?" And I was telling them about Capital Alliance. I was like, "I joined this group that Ken and Vatsal have created, and we get together 3 times a year, and it's essentially like your personal board of directors." And I can take any business issues that I have, or I can take any personal issues. Thankfully, nothing on the personal side yet, but I can take the business issues to them or personal issues. And you get this extremely smart group of people who are successful in their own right, like providing you feedback. We were talking about pattern matching, and so they're pattern matching against their knowledge and wisdom and providing you a level of feedback you would normally not expect to receive otherwise. And so that's what I told them, and everybody at that dinner table was quite surprised, and they're like, this is very powerful, very useful. And I was like, yeah, that's exactly why I'm involved with this. So essentially that's my answer, Ken. I really like the fact that things that I'm grappling with as an entrepreneur, as somebody who's building my company, where I'm in my head most of the time trying to think of, which direction should I go in? Should I add an 8th different strategy? Do I go to a new geography, if you will? Should I switch to a quant-based model, or should I continue picking and choosing stocks for client portfolios? These are the kind of questions I think I brought to the Capital Alliance, and I've received feedback from the group. And that is very valuable to me. The other thing that is valuable, and I think is going to become increasingly more valuable over time, is we live in a virtual world. We're doing this over Riverside Studio. We are probably all three in 3 different geographic locations. But I think people are going to value in-person interactions a whole lot more going forward, with things like deep fakes and people not being real, people saying all kinds of things when they're not in front of a person. People are, I think, starting to crave the human connection, in-person connections. And so I think this ability to come and meet multiple times a year, and not just share ideas with each other, not just ask for input from others, but this ability to connect at a human level in person, I think is going to be very valuable. So I enjoyed that part of it as well. Another thing that Capital Alliance has is everybody gives something. As you say, we are go-givers in some sense, not just go-getters. And we all have had very rich experiences over decades. And so we've figured out a few things. And so the ability to share these things with the group, I think, supercharges their progression through their career or through their business. So I think that part of it is also very valuable for me personally.
Yeah, thank you for sharing that. Yeah, I also find it just really fun. Now I look forward to seeing everybody.
Yep.
Obviously, like I created the group with Vatsal's help because I want to be in the group. That was really my selfish motivation. Um, and of course, I was fortunate enough that I learned the model from a different group. It's just in a different domain. And I got so much value out of it that I was like, wow, wouldn't it be so great if there was a group just like this for investors? And I actually looked for it, didn't find it. So therefore we created Capital Alliance. But obviously we just had our meeting in San Diego not that long ago, and the group continues to grow and gel. And now every time we get together, it's like seeing our our family that's been dispersed, and I look forward to it. And obviously we had a great experience on. We're going to have other folks from Capital Alliance on the podcast as well. But it's amazing to see an idea take shape. And of course, like Pabrai talks about, clone things that are good, clone success. That's kind of what we're doing. We're taking a successful model and just cloning it in this domain. So definitely can't thank you and others who jumped into the pool with us early enough, because without you guys, it doesn't exist at all. It's just an idea still in somebody's head, in my head.
Absolutely, Ken. And I'm thankful you guys thought of including me in this group. You're right about the fun part of it. Being on Michael's yacht the other day in San Diego and seeing a dolphin in the wild for the first time while we were sailing. And I made an amazing connection on that boat ride as well. We're having him on the podcast tomorrow, on our podcast. So just the fun part of it, the connections, all of it. I think it adds tremendous value.
Yeah, awesome. And let's end with so what's the future of Inside Arbitrage? Where do you want to take it, and what are things that you're working on to continue to be the leader or a leader in event-driven investing? And you could even say what's the future of event-driven investing if you have any insights on that.
Yeah, I think I want to continue to expand the platform. I've had a lot of fun building this. It's been very profitable in the sense that I get to use this platform for my own investing. I get a chance to work with my daughter, launch a podcast with her. So it's very fulfilling on so many different fronts. Having bootstrapped it all along, has both its advantages and disadvantages, but at least I'm able to control the destiny of the company to some extent. What I'm excited about is using the same patterns and applying it to other countries, if you will. So we want to expand to different countries. Maybe it's the Canada, maybe it's the UK and other places. So while I'm excited about that and that's the direction I want to go, I also realize that there are a lot of nuances. So we've figured out a lot of nuances over several years when it comes to mergers or insider transactions. So picking those up is going to be difficult as we go into different markets. Each of these markets behave differently, if you will. The regulatory rules are different. So on the one hand, I'm excited about that kind of expansion. On the other hand, I also realize it's challenging. It's not just about collecting data. It's about understanding that insiders cannot sell and buy within a 6-month period. There's a SEC short swing rule. So what kind of rules like that exist in Canada? Or what kind of rules does the UK have? What does Australia have? So that's going to be the challenge part of it. But then in business, as you know, you want to do the hard things. That's what gives you an edge. And that's what leads to success over a period of time. So that's what I'm excited about, taking what we've built and applying those patterns to other countries.
I'm glad you brought that up. So, how many other countries have enough data that you could apply or look for other, maybe just insider transactions, but maybe there's other things too,
Yep.
where you can comparably get enough data to where you can find signal?
I think on M&A activity, you probably have a smaller data set, right? Unless you're in like England, London. So there you might get more M&A activity. In Canada, it might be a little bit less. So it depends on each strategy. For example, in the UK, if you wanted to do a buyback, you have to actually announce that information, I think, on a daily or a weekly basis. So we might have richer data in the UK than we do in the US. Because out here, they announce the buyback, and then if you want to see if a company actually bought back stock, you're relying on the 10Q or the 10K data to see what happened to shares outstanding. In the UK, you get the data constantly. So I figure in some sense, we will lose some fidelity and access to certain strategies. In some cases, we'll gain more. And what we learn from those countries, we will be able to apply back to the US as well.
Yeah, that's fascinating. I mean, the international opportunity is probably vast, and we
Yep,
aren't even touching on countries like India, Japan, Korea. I mean,
exactly.
there's a whole long tail.
Yep.
So that's an exciting opportunity for your platform. Well, Asif, I think we're at the close of the episode, but I want to thank you for taking the time. I personally learned a lot. I think this people should watch this episode and share it with others, because I think that event-driven investing is an opportunity. It's a niche, but it's a really very rich niche, and it's one that I think most of us long-term investors haven't really focused on enough. I mean, that's one of my takeaways from this episode. I think I'm going to have to, figure out uh, to how to subscribe and start reading your stuff for at a minimum, because like I said, just one idea is all it would take to make the whole effort worthwhile, especially given the amount of capital and that we manage, for example. So thanks a lot for so generously sharing. I recommend people to follow your podcast. We're going to add it in the show notes. They should get your book and read it, and they should become subscribers. Those are my 3 takeaway recommendations.
Thank you so much, Ken and Vatsal. This has been a pleasure for me, and it's great to see you a few weeks ago. It's great to do this again. It's such a short period of time.
All right, awesome. Thank you.
Thanks for watching this episode. Click the screen to catch our past episodes with Saurabh Mukherjee and Matthew Peterson. And to apply for the Capital Alliance Mastermind, hit the first link in the description.